The Greek financial crisis that commenced in 2010, even though the recessionary tendencies have started in 2008, is unique in the history of financial crisis, in the sense that the decrease of GDP from 2008 to 2014 was more than 26%, unemployment increased tremendously and quite rapidly, immigration increased tremendously and quite rapidly. In fact, immigration of high-skilled human capital increased quite a lot between 2010 and 2013, and moreover and more importantly, this crisis has lasted for at least 6 years. One has to bear in mind that the greatest financial crisis in human history, which is the Great Crash in the United States in 1929, after 3 years, the economy started stabilizing, and in fact, after 4 years, the economy started growing. In stark contrast, the Greek economy was in constant recession. In fact, one might arguably claim that arrived at a depression level for more than 6 to 7 years. Thus, the combination of rapid GDP decrease as well as rapid unemployment increase, and in particular, youth unemployment reached the levels almost 50%, definitely more than 40%, can characterize the Greek crisis as a unique financial crisis in the history of economics. Now the question is, what were the underlying causes that brought about this crisis? The first cause, and the most important cause, were the strong euro and the low borrowing cost after the introduction of the euro in the Greek economy. And that means that the strong euro and the low borrowing cost were not utilized to improve and sustain growth in the economy, but they were basically used to increase consumption expenditures and investment into services and imported goods. Moreover, the oligopolistic structure of both the labor markets as well as the product markets in Greece was not conducive to the efficiency of the market system in the Greek economy. The unit labor cost also, due to political and other reasons, increased tremendously past the introduction of the euro. Therefore, Greece, in the beginning of 2010, started feeling this pressure from being unable to borrow from the international capital markets and was obliged to be able to sustain its expenditure and its economy, to ask for a bailout plan from the European Union. Now, this memorandum of understanding that was implemented to Greece, as we know by now, has failed multiple times. And the first bailout plan failed, and the second, and the third is in danger of failing again. And the question is, why did that happen? Well, the answer is that the main recipe that the IMF implements in these circumstances is dual. On the one hand, there is sharp devaluation of the currency, and at the same time there are structural reforms that basically correct the inefficiencies that bring about this economic collapse via fiscal consolidation, structural reforms, privatization, etc. In Greece, the problem was that because of the euro, you could not devalue the currency. Therefore, the IMF plan and the Troika plan, which was a combination of the European Commission, the European Central Bank and the IMF, was to implement internal devaluation whereby austerity measures were introduced in Greece for fiscal consolidation reasons and to reduce government expenditures. And despite the precipitous drop in government expenditures, more than 30%, and the reduction of the budget deficit for over 12%, in fact, in 2014, to a primary surplus of more than 2.5%, still it didn't work out. What were the reasons that this plan did not work out. First and most importantly were expectations. The destabilization of expectations from the commencement of the crisis, namely the negative publicity that Greece and Greek economy received from international media as well as from domestic politicians, basically prevented increased investments. Second, the horizontal cuts and the austerity measures were conducive and precipitated into a complete collapse of the effective demand of the country. Finally, the strong euro and the delayed implementation of quantitative easing by the European Central Bank did not enable the Greek economy to pick up steam and get out of the crisis. So now the question becomes, how would one deal with the Greek economy and what sort of policies should be implemented so that the Greek economy to exit the crisis? Given the PSI in 2012, which basically transferred the cost of the crisis away from the foreign creditors to the domestic Greek banks and to the domestic Greek pension funds, then it is immediate, as the IMF admits, to do debt restructuring. Debt restructuring is warranted since the high debt to GDP ratio is clearly unsustainable. However, the debt restructuring should be done in conjunction with a hard budget constraint. So fiscal consolidation should accompany the debt restructuring, and a hard budget constraint should be implemented so that to regain the credibility and the viability of the Greek economy. The hard budget constraint, together with debt restructuring, should be supplemented with public investments. With the mutual consent of the European Union, if the credibility and the viability of the Greek national debt as well as the economy is warranted, then public investments are necessary for the Greek economy to start growing. And this is basically the experience that we have seen internationally and in the Great Crash and many other international crises. First, one has to invest public funds into the economy, and then, given fiscal consolidation and structural reforms, private investments will follow subsequently. Therefore, public investments and a less front-loaded fiscal consolidation program that will encourage and will increase the effective demand of the Greek economy are necessary if the Greek economy is to grow. The international public investment should be directed to sectors of the Greek economy of internationally traded goods and start regenerating aspects of the Greek economy that for a long time are all but extinct. In other words, put differently, agriculture, tourism, light industry, trade and commerce should be reinvigorated in the Greek economy, because otherwise any kind of growth and development will not be viable, sustainable in the medium and the long run. Last but not least, the Greek economy had an expansion of the public sector, particularly during the late 90s and the early 2000s. So we need to transfer funds and all of the resources away from the public sector towards the private sector. Thus, the debt restructuring, together with public investments and a hard budget constraint, will re-establish the credibility and the creditworthiness of the Greek economy, and hopefully private investments and foreign direct investment will increase in the country, and then the new structure of the Greek economy will be able to stabilize expectations, and maintain continuous economic growth of the Greek GDP.